Apple just reported its latest results, and at first glance, the numbers look great. In Q3 2026, revenue reached almost $110 billion, up 16% year over year. Net income came in at nearly $30 billion, representing growth of 27%. Despite these strong results, Apple shares are down around 4% over the past 5 days. However, the stock has more than doubled over the last 5 years. So the question is now, is the recent decline a buying opportunity, or is too much growth already priced in? In this Simon Says video, I'll break down Apple's business quality and financials, its forward outlook, growth estimates and scorecard rating, and lastly its valuation to estimate its owner's earnings and determine a possible fair value of the stock. Before we start, here's an important disclosure. This video is produced by Simon Says Formula. I am a private investor, not a financial advisor, and this video is for general information and educational purposes only. Because this video discusses a specific stock and includes valuation estimates, it may be considered an investment recommendation under EU rules. However, it is not personal investment advice, and it is not tailored to your financial situation. At the time of this analysis and publication, I do not currently hold a direct position in Apple Inc. However, I may have indirect exposure through broad index funds, such as ETFs or mutual funds. My position may change after publication. You can find the full disclaimer and methodology in the video description. To understand Apple's business model, it helps to think of the company as more than just an iPhone manufacturer. Apple combines premium devices, custom chips, software, and services into one tightly integrated ecosystem. Once customers own an iPhone, they are more likely to purchase a Mac, iPad, Apple Watch, or AirPods, and subscribe to services such as iCloud, Apple Music, and Apple TV+. This creates strong customer loyalty, recurring revenue, and relatively high switching costs. Apple's business can be divided into two main areas: products and services. In Q3, products generated almost $79 billion, representing 72% of revenue. Now out of Apple's products, the iPhone still remains the most important product, generating almost half of Apple's total revenue. Services generated nearly $31 billion and represented 28% of revenue. This segment is particularly attractive because it produces recurring revenue and carries substantially higher margins than hardware. Geographically, the Americas remain Apple's largest market, followed by Europe and Greater China. However, the company generates revenue across the entire world, providing meaningful geographic diversification. Overall, Apple has a powerful ecosystem, an exceptionally loyal customer base, and a growing high-margin services business, which is why I give its business model a positive rating. Now let's take a closer look at Apple's revenue. In Q3, Apple generated $109.4 billion in revenue, an increase of 16.4% year over year. On a trailing 12-month basis, revenue reached almost $467 billion, representing growth of 14.2%. Looking at the longer-term development, Apple's revenue has increased by 112% over the last decade. That corresponds to a 10-year compound annual growth rate of 7.8%. Growth has been slightly slower recently, with a 3-year compound annual growth rate of 6.7%. These are not extraordinary growth rates, but they are impressive considering Apple's enormous size and established market position. One concern is Apple's outlook for Q4 26. Management expects revenue growth of between 9 and 11%, below Wall Street's expectation of approximately 12%. The weaker than expected guidance is primarily due to supply constraints affecting Apple's ability to meet demand, rather than an expected slowdown in customer demand. Despite this near-term constraint, Apple continues to deliver strong revenue growth at an exceptional scale, which is why I give its revenue a positive rating. Now let's take a closer look at Apple's profitability. In Q3, operating income reached $35.7 billion, representing growth of almost 27% year over year. On a trailing 12-month basis, operating income reached almost $155 billion, while the operating margin was an impressive 33.2%. This means Apple converts approximately 1/3 of its revenue into operating profit. Net income reached almost $30 billion during the quarter, representing growth of 27.1%. Trailing 12-month net income was approximately $129 billion, with a net income margin of 27.6%. However, part of the strong quarterly result came from a one-time tariff refund. The refund increased Apple's Q3 gross margin by approximately 2 percentage points and added 11 cents to diluted earnings per share. This benefit should therefore not be treated as recurring profitability. Looking at the longer-term development, operating income has compounded by 9.4% annually over the last decade, while net income has grown by 10.4% annually. Over the last 3 years, the growth rates have improved even more. The charts also show that Apple's profits were relatively stable between the year 22 and 25, before it started improving in 26. Finally, let's look at the development in earnings per share. Apple's trailing 12-month diluted earnings per share reached $8.72. Over the last decade, diluted EPS has compounded by 15% annually. This is considerably faster than net income growth because Apple has spent substantial amounts repurchasing its own shares. As the number of outstanding shares declines, each remaining share represents a larger ownership interest in Apple's profits. To sum it up, the recent tariff refund provided a temporary boost, but the long-term development still shows Apple's exceptional margins and consistent earnings growth. For these reasons, I give Apple's profitability a positive rating. Now let's look at Apple's cash flow. In Q3 26, operating cash flow reached $34.4 billion, an increase of approximately 23% year over year. On a trailing 12-month basis, Apple generated almost $147 billion in operating cash flow, representing growth of 35%. That gives Apple an operating cash flow margin of more than 31%. Apple also requires relatively little capital investment compared with the size of its business. Capital expenditure was only $2.5 billion during the quarter and approximately $10 billion over the trailing 12 months. This represents only 2.2% of sales. After subtracting capital expenditure, Apple generated almost $32 billion in quarterly free cash flow. Trailing 12-month free cash flow reached almost $137 billion, resulting in an exceptional free cash flow margin of 29.3%. In other words, Apple converts almost 30 cents of every dollar of revenue into free cash flow. Now let's go through the main cash flow highlights one at a time. First, Apple has delivered strong long-term operating cash flow growth. Over the last decade, operating cash flow has compounded by approximately 8.8% annually. However, free cash flow remained relatively stable at around $100 billion annually between 2021 and 2025, before accelerating significantly in 26. Second, Apple's capital expenditure remains exceptionally low. The company invested approximately $10 billion over the trailing 12 months, equal to just 2.2% of revenue. This is partly because Apple outsources much of its manufacturing to external suppliers. Third, Apple's free cash flow is frequently higher than its reported net income. This reflects the company's low capital requirements and its ability to convert a very high percentage of its profits into cash. The fourth highlight is Apple's capital allocation. Over the trailing 12 months, Apple retired approximately $17 billion of debt, repurchased around $82 billion of its own shares, and paid almost $16 billion in dividends. The dividend yield remains relatively low at approximately 0.3%. However, including share repurchases, Apple returned almost $100 billion to shareholders. That represents approximately 71% of its trailing 12-month free cash flow and a total shareholder yield of around 2.1%. Apple's strong cash conversion, low capital requirements, and enormous free cash flow generation are why I give its cash flow a positive rating. Now let's look at Apple's balance sheet. At the end of Q3, Apple held $62.4 billion in cash and short-term investments. At the same time, the company had about $84 billion in total debt. After subtracting its liquidity, Apple therefore had net debt of just under $22 billion. Apple's net debt represents only 0.14 times its trailing 12-month operating income. Combined with Apple's enormous free cash flow generation, this means the company could repay its net debt very quickly if management decided to do so, which is why I give its balance sheet a positive rating. Now let us have a look at Apple's capital efficiency. I use return on invested capital to measure how efficiently Apple uses the capital tied up in its business. After subtracting estimated excess cash, Apple had approximately $143.4 billion of invested capital at the end of Q3. I then calculate return on invested capital to measure how efficiently Apple uses this capital to make a profit. To calculate its after-tax operating profit, I apply Apple's effective tax rate to its trailing 12-month operating income. This gives us NOPAT, or net operating profit after tax, of about $128.1 billion. Dividing NOPAT by invested capital gives Apple a return on invested capital of about 89.3%. This means Apple generates around 89 cents in annual after-tax operating profit for every dollar invested in the business. This is one of the greatest returns of capital I have ever seen, and it really reflects Apple's high margins, asset-light manufacturing model, and low capital requirements, although share buybacks also increase the calculated ROIC by reducing reported equity. Nevertheless, Apple remains an exceptionally capital-efficient business, which is why I give its capital efficiency a positive rating. Now let's look at Apple's strategy and the main risks facing the business. Apple's strategy is to make its ecosystem even stronger through artificial intelligence, services, and tighter control over its hardware and software. The first priority is making Siri significantly more useful while protecting users' privacy. Apple wants Siri to understand questions better, know what the user is doing across different applications, and help complete everyday tasks. For many requests, the artificial intelligence runs directly on the iPhone, Mac, or iPad. This means the user's personal information does not need to leave the device. More difficult requests require greater computing power and are therefore handled through Apple's protected cloud system, known as private cloud compute. By combining artificial intelligence on the device with secure cloud processing, Apple hopes to make Siri more capable without forcing users to sacrifice their privacy. The second priority is growing Apple's high-margin services business. This includes the App Store, iCloud, Apple Music, Apple TV Plus, Apple Pay, advertising, and AppleCare. Services are now generating almost 30% of sales with an exceptional gross margin of 75.6%. Apple is growing this business by adding more features and content, bundling subscriptions through Apple One, expanding Apple Pay and Wallet, and encouraging customers to purchase additional iCloud storage. Apple also integrates these services directly into its devices, making it easy for customers to subscribe and continue using them across the iPhone, Mac, and iPad. The goal is to increase both the number of paying subscribers and the amount each customer spends within Apple's ecosystem. The third priority is gaining more control over both its products and its supply chain. Apple designs its own chips and develops its hardware and software together. This allows its devices to work smoothly together and gives Apple greater control over performance and the customer experience. Apple is also moving more production outside China and working with multiple suppliers to reduce its dependence on any single country or company. This should make Apple less vulnerable to component shortages, tariffs, and other supply chain disruptions. However, Apple also faces several important risks. The first is regulatory and App Store pressure. Regulators are forcing Apple to allow more alternative payment and app distribution options, potentially reducing its control over the App Store and the commissions it earns. The second risk comes from supply constraints, tariffs, and Apple's exposure to China. Management guided to Q4 revenue growth of 9 to 11%, below expectations of approximately 12%. The weaker outlook reflects increasing component constraints as well as a significant negative effect from currency movements. Tariffs, rising component costs, manufacturing concentration, and increasing competition from Chinese smartphone companies create additional uncertainty. The third risk has two separate components: hardware concentration and Siri execution. Firstly, the iPhone still generates almost half of Apple's revenue, leaving the company exposed to weaker demand and longer replacement cycles. Secondly, despite Apple's ambitious artificial intelligence strategy, Siri remains a major weakness. In my experience, Siri frequently struggles with relatively simple requests and feels far behind competing artificial intelligence assistants. Apple therefore has a lot of work to do before Siri becomes a genuinely useful and competitive product. Despite these risks, Apple's enormous customer base, powerful ecosystem, growing services business, and control over its hardware and software support its long-term competitiveness. Because I believe these strategic opportunities outweigh the risks, I give Apple's strategy and risks a positive rating. Moving on to Apple's forward outlook, analyst expectations remain positive, although revenue growth is expected to moderate after 26. Revenue is expected to reach approximately $477 billion in 26, representing growth of 14.7%. Analysts then expect revenue to grow by another 9.1% in 27, 7.1% in 28, and 9.6% in 29. This would bring Apple's annual revenue to approximately $611 billion by 29. The earnings per share outlook is slightly stronger. Diluted earnings per share are expected to reach $8.80 in 26, representing growth of approximately 18%. Analysts then expect earnings per share to grow by another 9% in 27, 11.4% in 28, and 10.5% in 29. This would increase Apple's earnings per share to about $11.80 by 29. The fact that earnings per share are expected to grow faster than revenue suggests that analysts expect Apple's margins and continued share repurchases to support per share growth. These are analyst estimates rather than guidance from Apple, and they could change significantly depending on component availability, iPhone demand, services growth, and Apple's execution in artificial intelligence. Nevertheless, the combination of continued revenue growth and expected double-digit earnings growth supports a positive rating for Apple's 3-year growth outlook. To estimate Apple's growth over the next 3 years, I start with trailing 12-month revenue of approximately $467 billion. Based on analyst forecasts, revenue is expected to grow by 2.3% during the remainder of 26, 9.1% in 27, 7.1% in 28, and 7.2% during the first 3 quarters of 29. Compounding these estimates gives us total revenue growth of about 28% over the next 3 years. That is equivalent to approximately 8.6% annually and will be the growth estimate used in my valuation model. Bringing everything together, Apple receives positive ratings in all 9 categories. Its premium device ecosystem, strong customer loyalty, and growing recurring services revenue support a positive business model rating. Revenue has compounded by 7.8% annually over the past decade, while operating income has compounded by 11.3% over the past 3 years. Apple also maintains an operating margin above 33%, resulting in positive revenue and profitability ratings. Cash flow receives a positive rating because Apple converts 29% of its revenue into free cash flow, while capital expenditure represents only 2.2% of sales. The balance sheet carries very little financial risk, with net debt equal to only 0.14 times operating income. Apple also generates an exceptional return on invested capital of approximately 89%, supporting a positive capital efficiency rating. Apple's artificial intelligence and services strategies provide additional growth potential, although this is partly offset by regulatory pressure, supply chain risks, and the company's weak execution with Siri. Based on analyst forecasts, I estimate compounded revenue growth of approximately 28% over the next 3 years. Finally, my risk assessment produces a required return of 5%. This means I am looking for an owner's earnings yield of approximately 5%, equivalent to paying around 20 times owner's earnings on an enterprise value basis. Overall, Apple enters the valuation with an exceptionally strong scorecard. Now we move on to owner's earnings, a concept popularized by Warren Buffett. The goal is to estimate how much cash Apple could realistically generate for its owners after the reinvestment required to maintain the existing business. Rather than relying on reported net income, I begin with Apple's trailing 12-month core operating income. I then adjust this figure for taxes, add back depreciation and amortization, and subtract estimated maintenance capital expenditure. For maintenance capital expenditure, I use Apple's reported CapEx of approximately $10 billion and add 10% as a margin of safety. After applying these adjustments, I estimate that Apple generates approximately $130 billion in annual owner's earnings. This represents the cash Apple's underlying business could theoretically generate for its owners after maintaining its existing operations. Based on Apple's current enterprise value of approximately $4.5 trillion, the company is trading at around 35 times estimated owner's earnings. That corresponds to an owner's earnings yield of approximately 2.9%. Now that I have estimated Apple's owner's earnings, I can calculate what the company could be worth based entirely on its current earnings, with no future growth included. For this baseline valuation, I apply a multiple of 20 times owner's earnings, which is equivalent to requiring an owner's earnings yield of 5%. Applying this multiple to estimated owner's earnings of about $130 billion gives an enterprise value of roughly $2.6 trillion. I then subtract Apple's debt and add back cash. This gives an estimated equity value of approximately $2.58 trillion. Finally, dividing that equity value by Apple's 14.6 billion outstanding shares gives me an estimated fair share price of approximately $176.80. This is my conservative baseline valuation because it assumes that Apple's owner's earnings never grow beyond their current level. The previous valuation assumed that Apple's owner's earnings would never grow. This valuation instead estimates what the company could be worth in 3 years if it successfully delivers the expected growth. Based on Analyst revenue estimates, I expect Apple to grow by a compounded total of approximately 28% over the next 3 years. Assuming owners' earnings grow at the same rate, they would increase from about $130 billion to around $166.6 billion. I then apply the same multiple of 20 times owners' earnings and adjust for Apple's debt and cash position. This produces an estimated equity value of approximately $3.3 trillion. After dividing that equity value by Apple's 14.6 billion outstanding shares, I arrive at an estimated 3-year growth-adjusted share price of approximately $226.80. It is important to remember that this is an estimated value 3 years from now, rather than a fair value for the shares today, and it depends on Apple achieving the expected growth. Putting both valuation scenarios together, Apple was trading at approximately $309 on the 31st of July. Based only on current owners' earnings, my estimated fair price is approximately $176.80. That represents potential downside of approximately 42.8% from the current share price. Under the more optimistic growth-adjusted scenario, Apple could be worth approximately $226.80 in 3 years. However, even this future value is approximately 26.6% below Apple's current share price, despite assuming that the company successfully achieves the expected growth. I also apply a 15% margin of safety to protect against forecasting errors and unexpected developments. This gives me a buy price of approximately $150 based on current earnings, or about $193 based on the 3-year growth scenario. Both values remain significantly below Apple's current share price. Overall, Apple's valuation appears to price in considerably stronger growth, a higher future valuation multiple, or a combination of both, leaving investors with no margin of safety under my assumptions. So where does this leave me with Apple? At approximately $309 per share, the market appears to be pricing in significantly more growth than my valuation model assumes. Based only on current owners' earnings, my estimated fair price is approximately $177. Even under my 3-year growth scenario, the estimated future value is only around $227, approximately 27% below the current share price. Apple nevertheless remains one of the highest quality businesses in the world. It has an exceptionally powerful ecosystem, strong customer loyalty, enormous cash generation, high margin services revenue, very low financial risk, and exceptional capital efficiency. However, an outstanding business is not automatically an attractive investment at every price. At the current valuation, investors are accepting an owner's earnings yield of less than 3%, while assuming that Apple will continue delivering strong growth for many years. For that reason, I would not purchase Apple at its current price. I would rather wait for the shares to trade closer to my estimated fair value range and provide a meaningful margin of safety. Apple is an exceptional company, but too much optimism appears to be reflected in its share price today. Thank you so much for watching. If you found this analysis helpful, please hit the like button and subscribe to Simon Says for more stock analysis. And let me know in the comments whether you think Apple is still a buy at its current price. I'll see you in the next analysis.